Good. Welcome to those that are just joining us. We're just going to give it a minute as people are streaming on. Welcome, welcome. Good. Welcome to those that are joining. We're just going to give it a few minutes because it takes a little bit of time for all of the participants to join. Good, that number's settled. So we're going to kick off. Hi, everyone. Thanks for joining us. I'm Kristen, General Manager of Hatch, and it's really great to have you spend the next hour with us talking about tax. Now, to survive this, I hope everyone's got a drink in hand. If you don't, run and grab one. I've got mine. Tax goes quite well with a drink, so please do. It's 5:30. You're sure you've had a long day back at work, and we are going to have a great hour chatting about tax. So please do just grab a drink, relax, sit back and relax. We have a lot of great people to chat about a number of things tonight. So we're going to kick off. So as I said, I'm the General Manager of Hatch. Hatch has been live for 18 months. We've got over 150 million, actually, I think it's probably well over 160 million invested through Hatch now, tens of thousands of customers, and I really welcome you here to learn about that. We've got some fantastic guests from Sharesight and from Kiwibank. So I'd like to welcome the speakers tonight are Natalie. She is our head of customer for Hatch. Natalie and I were at the very beginning of Hatch, and she is the one that's actually designed everything. For those that have used Hatch before, you're basically entering into Nat's brain, which is fantastic. We've got, welcome Jess. She is the head of partners and clients at Sharesight. She basically, a large part of her role is working with other companies like Hatch to team up together to further help investors. So I look forward to having Jess chat a little bit about Sharesight and answer those tough questions. We're also really happy to have Scott as part of Sharesight as well. Finally, welcome to Dean Riley and Isla Harling. Dean is the head of group tax at Kiwibank, and Isla is group tax manager joining us also from Kiwibank, and they're here to answer your tricky tax questions. Isla and Dean are corporate tax professionals specializing in financial services. Now, Hatch is part of the Kiwi family, so we have fantastic resources at hand, and look forward to picking their brains tonight. So as you're aware, Hatch and Sharesight have partnered to make every step of the investing journey process simple and affordable, from trading to tax time. When you invest through Hatch now, you can connect to your Sharesight account and automatically send through all of your buy and sell trades to track in one place. So together, we're making tax time easy, from analyzing to reporting on your overseas investments. And so what I'd like to do today is just take you through, we're going to have Natalie take us through a little bit about Hatch, and then Jess and Scott are going to give us a quick overview on Sharesight, and then Dean and Isla are going to give us a general overview of foreign tax and why it matters. And then we're going to open it up to Q&A. Now, you'll have a Q&A box in your Zoom screen, so I'd encourage you from now, feel free. We've got some pre-submitted questions that we are going to cover, and I'll be directing those to the right people. But you've got a Q&A box, so please feel free to ask anything about Hatch, about tax, about non-tax related, about investing, about Sharesight, and I'll be moderating those, making sure that they are answered. So again, welcome. Please do feel free to ask some questions, and I'm going to kick off by handing it over to Nat to give us an overview of Hatch. Oh, sorry, disclaimer, legal stuff. Can't forget the legal stuff in this industry. It was up, but basically, there we are. Thank you. Thanks so much, Jess. This webinar is for informational purposes only. Generally, when we go and do talks, we say it's general. We're not here to give really your situation's very unique. If you have any questions about investing very specific to your situation or tax, please connect with your respective advisor. So really, views here that are expressed are quite general, and we're really trying to give general tips and tricks in that space. Now I'm going to hand it over to Nat to chat about Hatch.
Hi everyone, thanks Kristen. So some of you may have been at last week's Hatch and Sharesight webinar, but just for anyone, I'll try and boil it down really, really quickly. Who is Hatch and how do we work? Hatch allows everyday Kiwis to build your own portfolio of the world's most successful brands, companies, and funds. And that's kind of a little known fact. We have over 500 ETFs listed on Hatch, from Apple as a company to the likes of BlackRock and Vanguard, iShares, ARK, as well as some other big name companies like Tesla and Zoom, and 3,500 more. We started with the US share markets, but we have much bigger plans than that. Our goal is that Kiwis are going to be able to back what they believe by investing in a whole range of things that speak to their hearts, minds, and wallets. So we're all about informed, educated investing and growing your money over time, aka getting rich slow. As Krista mentioned, we are part of Kiwi Wealth, and we kind of consider ourselves your investing sidekick. We like to meet investors where they're at, and what that means is if you're a first timer and you've never invested before, and you want to take the reins and put your money to work, we're going to help you get started. So we've got a free 10-day getting started course that walks you through all the basics and fundamentals in plain English. No one's going to make you feel stupid. We also have a whole bunch of other resources and help that helps you kind of get over that hump, that really big mental barrier of making that first investment. If you're an investor already and you're looking for a smarter way to invest, we've got a whole bunch of tools. We've got limit orders, stop loss orders, and we've got auto investing, so you can sort of set up your automatic deposit from your bank account and set and forget. And if you're a really experienced investor, we give you all those powerful tools that you really want when it comes to investing large sums of money. So like I said, we have limit orders, stop loss orders are very much on the way. And of course, we connect with really great partners like Sharesight and Henry are our first two. Quick rundown on our fees. We very much believe in fair and transparent pricing. Like I say, we're after informed, educated investors. So we don't want to hide anything from you. So when you invest through Hatch, it's just 0.5% fee included in the exchange rate. So you can invest anything from $1 up to $100,000 before we give you a little bit of a discount on that exchange rate, which is, I think, it's the lowest I've seen. We've got a pretty low FX fee. And then you can just invest in anything up to 300 shares for a flat $3 a trade. Over that, it's just 1 cent a share. And that's basically it. Really small annual fees, 50 cents a year, and $1.50 in your first year to cover all your US tax filing obligations. So I would consider that quite a bargain. You can also talk to the entire Hatch team basically at any time. That's all included in your $3 a trade. We're local. We are really amped about growing your money with you, and we plan to be here in 20 years time, so that we kind of can see the first tranche of Kiwis coming out the other end with their wealth grown.
Thanks, Nat. Awesome. So please feel free to ask any further Hatch questions. I'm on hand to direct those to the right people. I just want to hand it over to Jess to give us an overview, and or Scott to give us an overview about Sharesight.
Thanks. So Sharesight is a portfolio tracking and tax reporting tool. We have over 130,000 investors worldwide. It's created by self-directed investors for self-directed investors, and it gives us the full picture of our investment performance with everything in one place. We support over 30 stock markets and managed and mutual funds in Australia, New Zealand and Canada. And you can also add unlisted investments into Sharesight, such as investment properties and artwork. So you really can have everything in one place. Sharesight calculates your performance, including stock prices, dividends, dividend reinvestments, brokerage and currency fluctuations. So you really have the full picture of your investment portfolio. So it provides you with the true performance of your investments. We also have powerful tax reporting solutions. So for you Kiwis out there, we've got the taxable income and the fifth report, which Scott is going to talk to in a moment. We're really excited to join partnership with Hatch to kind of really help you as investors invest in international markets and then be able to do your tax reporting and track it inside of Sharesight. So I'm going to hand over to Scott, who's going to do all the demos, all the hard bits. So over to you, Scott.
Cool, thanks, Jess. So I'm just going to share my screen and give a really quick demo. Sharesight. 1 second. Here we go. So this is what a Sharesight portfolio looks like. This one has some ASX stocks and some NZX stocks in it, and a bunch of US stocks, purchased through Hatch, of course. As Kristen mentioned, Hatch will send through your buy and sell transactions to Sharesight as you trade. Sharesight will basically calculate the other stuff. So we're alerting here to say that there's some unconfirmed transactions in the portfolio. So if we jump into this one, which is just a Vanguard, US Vanguard ETF stock, this is my buy trade that's come through from Hatch, and Hatch passed through the order ID, etc. Sharesight will calculate and record the dividend payments that you've received on this. So the dividend payments are not fed through from Hatch, but Sharesight calculates those. So we calculate those basically by using the cents per share dividend payment that's announced, and then we calculate your US resident withholding tax. So that's calculated at the 15% rate, which is the correct rate provided that you have filled in your US non-resident tax form, which is all part of the sign up and onboarding process into Hatch. So as a Hatch customer, you will have already done that. We're populating an exchange rate. Obviously, when you're trading through Hatch, your dividends are going to get banked into your US dollar bank account, but you need to have an exchange rate basically for New Zealand tax purposes. So you can just go ahead and use Sharesight's rate. That's just an end of day bank rate. And yeah, so basically from that we have all of the dividend payments. You can click into these, and we'd recommend that you just check, cross-check against the information that you get from Hatch. You can edit this stuff if you need to, and then you just basically save and confirm your dividends. So in terms of tax reporting for a portfolio, basically the main consideration is whether you are subject to foreign investment fund tax reporting. And generally speaking, the threshold for that is basically whether you own more than $50,000 worth of overseas shares at cost. If you don't, tax reporting is really simple in Sharesight. You'll just come along and run the taxable income report. This will default to the financial year, and basically in New Zealand you're just paying tax on dividends. So this report just lists out all of your dividend payments, sums up the totals. The tables are split into your local and foreign income. So this report basically just gives you the totals that you need to copy into your tax return. So it's nice and simple. If you think that you might get caught under the foreign investment fund regime, then tax reporting is a little bit more complicated. So like I said, the determining factor for whether you're caught under FIF is whether you hold more than $50,000 worth of shares at cost. That's the case if you're an individual investor, which I guess most of you will be. Bear in mind that there are some exemptions to that. So if you hold shares as a company, for example, you might not have a threshold amount at all. If you held shares jointly, you might have a different threshold amount, for example, $100,000 if you own shares jointly with your partner. So this first page of the FIF report, this is available to all Sharesight customers, and it basically allows you to assess whether you're caught under FIF. So we're showing all of your foreign stocks. We're applying a standard rule set to determine if any are exempt. And the key exemption these days is that basically Australian shares listed on the ASX are not considered foreign investment fund companies. So Sharesight will automatically deselect those, and the rest are selected for you. Again, if you really need to, you can override these selections, but generally speaking, you wouldn't need to. So we're calculating your peak balance here, and we're basically leaving it to you to determine whether that's above or below your threshold amount. In this case, it's our threshold amount's over $500,000, so clearly we're going to have to report tax under FIF. So to run this report, you can simply click calculate, and Sharesight will basically on this page give you the numbers that you need for your tax return. There's two broadly speaking, there's two methods that you can use to calculate foreign investment fund tax, and generally speaking, you're allowed to use the lower of those two methods. So the first method is the fair dividend rate, and I guess the quick summary of what this means is that basically you are paying tax based on 5% of the opening value of your investment. So your taxable income is simply 5% of the opening value. The other method is what's called the comparative value method, and this is basically looking at your actual gain in market value plus dividends, and literally paying tax on the gains that you've made. So I won't dive too much into all of this stuff just for the sake of time on the webinar. But basically these tables will give you the numbers that you need. So if we look at the fair dividend rate method, you've got your foreign investment fund income in the first line. Your exempt overseas income is basically just dividends on anything that's excluded from the foreign investment fund definition. In other words, typically dividends on ASX stocks. And then we calculate any tax credits that you can claim. So this would be any foreign withholding tax that you've paid may be available to claim as a tax credit. You can dive into full details of all of this stuff, and we go really deep into basically showing you how all of these numbers are calculated, and we kind of provide worksheets for everything. So you can share that with your accountant if you're getting your accountant involved, and they have all of the detail there. This whole report is also able to be exported as an Excel sheet, as a PDF, or you can just get it into Google Drive and open it up in Google Sheets as well. And you'll find along the way that we've got really good help documentation that goes along with all of this stuff as well. So there's various links within the report to open up our help pages. Yeah, so I might leave that there for the demo, and we can come back to anything else, I guess, during question time.
Thanks, Scott. I just want to open it up to Isla and Dean or Dean to fill in any general kind of foreign tax, fill in any gaps from Scott's quick overview. That would be super helpful. And then I've got some tax questions already, but don't know if Isla or Dean, you guys want to kick in with just a very quick overview.
Hey, Kristen, sorry about that. Just a small issue, but yes, I certainly can. And look, to be honest, the first comment I'd really like to make is a big well done to everyone for coming along and joining tonight. Wednesday night tax isn't everyone's cup of tea, but you all coming along tonight and being here, shows that you're interested in what tax means for your Hatch investments. And I think that's great. Obviously warms my heart as a tax guy. But I think it's absolutely great that you want to learn and use that knowledge to get it right. So big well done. Key message for me, I think for everyone, is that the good news is that tax on overseas investments actually isn't that complicated. And some of the things that Scott just covered off there shows how so much of it can actually be all automated. So really looking forward to chatting that through in a sec. Do need to emphasise those earlier comments that Nat made. We can only make general comments, so can't give any sort of personal advice tonight at all, unfortunately. Fully recommend, though, if you've got a specific query that's right related to your particular circumstances, reach out to a professional and get some proper advice. A key other point I think I'd like to make first up. I mean, it's not that difficult. And secondly, there's a lot of really good information out there. I mean, the Hatch website itself has some really good, I think, general guidance on what tax means for overseas investments. The Sharesight partnership is fantastic. Having all those calcs able to be automated is a real step forward. And thirdly, even Inland Revenue, to be honest, has put out some really good information on this stuff. And if anyone's wanting to do a bit of a read, they've put out a document that they call their IR 461, which is basically their guide to tax on overseas investments. And to be honest, it's a pretty good read. So key message from me: don't let tax hold you back. Perhaps, Kristen, before we get into some Q&A, I could just quickly cover off again what Scott touched on earlier around how your hatch investments are taxed, basically, which is a question that we get asked quite a bit. And as Scott mentioned, the answer at a real high level depends on whether the cost of those investments was 50K or less. So if the cost of your hatch investments is less than 50K, the tax treatment is very straightforward. Basically, you're taxable on any dividends you receive only, unless you bought those shares for the purpose of selling them, or perhaps you're a share dealer. So yeah, less than 50K cost, it's pretty straightforward. If the cost of your hatch shares is more than 50K, again, it's pretty straightforward, but you're taxed under a different set of rules called the Foreign Investment Fund or FIF rules. Basically, all that means is that the tax you pay on those investments is calculated a bit differently. And Scott mentioned there the FDR and CV methods, which we can talk about more later. Either way, you do need to file a New Zealand tax return if your income's over $200 a year. That's the income you get from those offshore shares. So that's a real quick high-level overview as to how it all works, Kristen, but welcome any specific questions that have come through.
Before we let you go, Dean, just have a couple, if you could clarify that 50K, is that New Zealand or US dollars?
That's NZD. Great question.
Great. So that's NZD. And then the last question, and it was something you touched on. I can't wait to read the 461. Was it 461 or 416? I've already forgotten.
It's the 461.
Oh, keen bean, Gareth. That's awesome. Perfect. So the de minimis threshold of 50K is original cost, isn't it? Yes. So if I bought some shares 5 years ago and some yesterday, how do I calculate the total and how do I treat the FX so that I need to know what the FX rate is from 5 years ago? I don't think so, do we? It's just, again, the 50,000 New Zealand, isn't it?
That's correct. Yeah.
Perfect. So it's the cost, the original NZD. Perfect. So we don't have to worry about FX. Fantastic. And then the last thing about what you said, sorry, Dean, was, oh, I know. And this is a very common one. We get this a lot. And I wonder if the IRD make this gray on purpose, but you called it dealer, share dealer. We've also known, trader. How do we know if people are traders? Is there hard and fast rules as to how often they trade? Yeah, that would be great.
That's a super question. The short answer is no, there aren't hard and fast rules. And this is something that is so grey, it's actually gone right through the courts with Inland Revenue, taking taxpayers to court saying, hey, you're a share dealer, and the taxpayer saying no. And even the courts have decided, both ways. So it definitely is grey. In terms of general guidance, I think what we can say is that a dealer, as you'd expect, is a person who's buying and selling stuff, in this case, overseas shares, pretty regularly. The way Inland Revenue looks at it is they look at the person's actual activity. So Inland Revenue isn't so much interested in what a person might say, like in terms of explaining their intention or motive or purpose. Inland Revenue very much focuses on their actions. So the sorts of things that Inland Revenue look at to determine whether or not they think someone's a dealer or not, the frequency of transactions. Is this a person who's trading, several times a day or more sort of once or twice a week, for example? The circumstances for the transactions. In other words, why did the person trade? Was it to do something, perhaps to fund something happening in their personal life, which would indicate they're not a dealer, or was it very much to take advantage of something happening in the marketplace? Those sorts of things. A couple of other factors. Inland Revenue does look at the scale of the activity. So is this something that the person's just sort of doing off to the side, so to speak, or is this their full-time job? Those sort of distinctions. And finally, and this is a little bit of a difficult one to explain, but Inland Revenue does look at relativities between the size of an investor's overall portfolio and the turnover of that. You know what I mean? So if a person was consistently trading in such volumes that their entire portfolio was turning over very regularly, that would indicate the person's probably a dealer. Whereas, you know, if a person was making, if their turnover, I guess, was much smaller compared to their total portfolio, it would indicate that they're not. So no hard and fast rules, but they are some of the things that Inland Revenue look for when determining whether someone's a dealer or not.
Fantastic. Thanks, Dean. Always like to keep it grey. IRD. Fabulous. Good. Just a quick question now for Scott or Jess. Would just like to know, what can be done on the free version of Sharesight? Can you talk about that? And then how do shares show up from Hatch onto Sharesight automatically?
Okay, yeah. So the fifth report that Scott was showing you, that's on the expert plan. So that's one of our premium plans. The taxable income report is on our free plan, and on the free plan you can track 10 holdings, have one portfolio, and some of the features and some of the reports. So you can sign up completely for free and just get your stuff in and give it a go. So Hatch have built a connection through to Sharesight. So on the Hatch website, it's within the partner page, isn't it, Nat? That someone, she's nodding, you click on, and then that will bring you over to Sharesight. You sign up, and through that connection, Hatch will, you have the option to push in all your history, and then every time you trade, your trades will come in. If you're a already existing Sharesight Hatch user, if you've been using the trade confirmation emails, just make sure that you don't click your history to be imported. Otherwise, you will duplicate your all your trades, and it means you will have to go through and delete all of them. So just make sure that if you've been using what used to be called the broker email import feature, which is now called trade confirmations, trade email confirmations, that you just don't import your history.
Sorry, that was my fault. I think in my intro, I was meant to show a little bit about how we connect. It's really, really easy, and we'll do a quick screen thing demo that we'll post around. But all feedback so far is it's ridiculously straightforward. And I just wanted to follow up on Jess' comment about the expert plan, because we've been asked this a little bit, but one of the things that I feel really strongly about is up until now, you've basically had to pay an accountant to do a lot of the stuff. And especially with the Hatch special offer, the 1 year annual plan for a Sharesight expert plan is just really, really great value to be able to get all that stuff. So yeah, I just wanted to confirm that it's not, that it's actually a really good deal.
Nat, while you're on, I might just keep you quickly because we've got a lot of other tax questions, but very quickly with Hatch, are you looking to add other share markets?
Absolutely. Hatch wants to be a one-stop shop for everything to do with your money in the years to come. So the US share markets we started with because they account for about 85% of global investing, but that's absolutely just a starting block for us. We have a lot of requests for the ASX and NZX, so they're obviously being looked into at the moment. We have these 500 ETFs already on Hatch, but we know there's so much more we can be doing with funds and allowing people really easy set and forget options. The world is our oyster, and we absolutely, our goal is to make it really simple, really straightforward, and really empowering for New Zealanders to grow their money. So nothing is off the cards at the moment, and always keep just asking us for what you're after, because we really do build Hatch around what New Zealand investors and non-investors who want to be investors are interested in. So we keep an absolute long list of everything people ask for. We tag everything, so nothing goes unnoticed, and we do build Hatch around that.
Awesome, thanks. Just quickly on the Australian shares, Jess, I might just ask you, why is it that some Australian shares are subject to fifth income rules and not others?
That's not a question for me.
Scott. Sorry, Scott.
Yeah, so the rules have been simplified somewhat around which Australian shares are exempt, because it used to be the case that they had to be on an approved index, and that was kind of really quite difficult to figure out. These days, I believe that the rule is essentially if it's an Australian share listed on the ASX, then it's exempt. So there are some foreign stocks listed on the ASX or non-Australian stocks, and they would kind of be classed, they would still be included as a foreign investment fund. But generally anything that's Australian, I think maintains an Australian franking account, is excluded, which is essentially the large majority of anything that you would buy on the ASX.
Thank you, thank you. I'm going to go back to tax, Isla or Dean. Can you walk us through ADRs? So Hatch does offer foreign companies that are listed on the US share markets by an investment bank are called American Depository Receipts, ADRs. And I don't know if Dean, if you're up for it, just chatting very quickly about taxation of the ADRs. If you're not aware, that's fine. But and finally, does Sharesight provide all the information to claim imputation credits for these if they exist? So I wonder if we.
It's a great question. It's something I looked at a while ago. Isla may have considered it more earlier than me, so a little signpost there for Isla if you know, if you want to chime in. I think where I got to was that it is possible for certain ADRs to be treated under the FIF rules, but I think it very much depends on a case by case kind of basis. But Isla, is there anything you'd add to that?
Yeah, I seem to again recall, I think, a similar query, and it was a few years ago now, so my memory is a little bit hazy, but it probably will be a FIF. Which country it is kind of doesn't really matter, because as we've said, it's as long as it's not an Australian listed or New Zealand, then it's the same tax treatment. I think I saw one of the questions there around sort of double taxing it. If you're a New Zealand tax resident, like I expect most of you are, then you're just going to get taxed the once on that FIF income, either under the FDR or the comparative value rules. I don't know if that's the question that I think I saw on the chat.
Yeah, perfect. That's great. We just want to be very clear on FIF again, with respect to the timing from when, if we could just talk about the timing. Hang on, I've just got a specific question here. Is the 50K threshold only valid at the end of the fiscal year? So if it goes over during that year, then it, but then falls back under, is it okay? So is it just, can we talk about the, from when to when do we look at the 50,000 and just be, I just want to be really clear from what I'm hearing, is it's the 50K investment, not the value of your portfolio during that time. So I'm not sure who wants to answer that.
Oh, look, I'm happy to. Yep, so it is, you have to look at all times in the year, and you have to look at the highest amount basically. So you could be under the New Zealand dollar 50K at the start and the end of the year, but go over it one day in the year. Unfortunately, that then takes you over the threshold, and all your income is subject to the FIF rules. It is a cost calculation, so hopefully the value of your investments is higher than that. But what you do is every time you acquire some shares, from a tracking perspective, and I'm sure Sharesight does this, you take the foreign currency amount you invest in, say US dollars, use the translation rate for their day of purchase. You also have to add on brokerage fees, and then add up all of the amounts you've got and then track that during the year. But I'm fairly certain I've seen on the Sharesight you had that peak holding, didn't you, Scott, to calculate all that for investors. So yeah, unfortunately, it's not about the start or the end of the year. You have to look at the whole year.
Thank you. So that would be the same for the question about dollar cost averaging. The minute that you've, the fifth, it sounds like the fifth month, if you're investing 10K a month, the fifth month you hit it, then absolutely you're subject to the fifth rules. So that's,
yeah, for the whole year.
Assume that's taken. With respect to, dividend is less than $200. However, investment value has gone up. Still not required to file an IRD return. I heard that it was just the income, the proceeds has to hit $200. Is that correct?
So it's the income. Yep, it's the taxable income. So if, for example, you're under the 50K limit and you weren't dealing or trading in the shares, then you should only need to look at the gross dividend income. And just to be clear, that's the dividend income plus any withholding tax that you've suffered. So you might get in $85, but the dividend itself is $100. And because there's been $15 of withholding tax that I think Scott mentioned earlier. So you have to take that $100 and see if that, and anything else is over the $200 limit, if that makes sense.
Yep, perfect.
That idea, sorry, of the withdrawal tax being suffered, but just to clarify, that's also added to all your other non-taxed income, right? So you're paid,
yep.
pay and stuff is all not counted as that, but if you've earned other income in the year and the total amount, including your hatch dividends, adds up to over $200, that's when you go over the threshold. It's not just your hatch dividends.
Absolutely, very good point. And I suppose the same with the 50k test. It's not just your hatch shares, it's all of your FIF investments. So and it might be, so just to be clear, because it might be things people worry about, that a FIF won't include KiwiSaver or any New Zealand pies, because they're New Zealand rather than foreign vehicles, so that doesn't get added in, but you would need to add any other foreign investments that you have to test that 50k. But good point, Nat.
Fantastic. Dean, if you invest, if you've got 50,000 invested and you consider yourself a trader for a given period, but you sell those shares 5 years later, are you subject to capital gains on those? That's a tricky one.
Yeah, that's interesting. So we're saying when we bought them, we didn't consider ourselves a dealer, but when we
did. So when we bought them, we considered ourselves a dealer.
Right.
But then when we sold them, we didn't.
Yeah, that's a great question. I think the way that test works is that you assess whether you're a dealer or not at the point you sell them, I believe.
And do you have to declare that, or you automatically just say, even if it's under 50K, you automatically just go to FIF if you're a dealer? Is that correct? Or sorry, not FIF, but yeah, do you have to declare if you're a dealer, or you just file taxes in a different way?
Yeah, that's right. If you're a dealer, you just file your return as if you're a dealer. So to be really clear for everyone, if you're under 50K and you think you're a dealer in shares, that means any gains that you're making on those shares, you should be treating them as taxable. They should all go on your tax return. But the flip side of that is that any losses you make on those shares also go into your tax return and are deductible. So it works both ways.
Perfect. Can I ask about different shares, Jess or Scott? So if I have any other international broking accounts, can I add them to Sharesight?
Absolutely. We support 30 stock markets. We have connections with other brokers as well. We also have a generical spreadsheet importer, so you can get everything into Sharesight and track it all in one place. Absolutely.
Yep, we have a complete history of price and dividend data, typically going back at least 20 years for all of the markets we support as well. So there's really no limit to what you can record. You can record all of your historic transactions, and Sharesight will calculate out the dividend payments and value them, etc. And even if you have purchases predating that, you can still record all of that stuff, because Sharesight is designed so that you can manually record or edit anything you like. So you can get everything into Sharesight, and that's really important, of course, to make sure that everything's considered in your FIF reporting.
Thank you. Natalie, can you just remind us again how to link our Hatch accounts to Sharesight, firstly, and secondly, does Hatch provide a tax report of dividends and interest received during the year?
Okay, I was going to say, firstly, this is the most fun tax conversation I've ever had. I'm loving it. What a surprise. I didn't even need my wine. So yes, first up, yeah, like I say, we'll do a quick video on it, but basically what you need to do is, once you're in Hatch, you click on account settings, and then you'll see partner connections, and then right in there is Sharesight straight away, and then you just click on connect Hatch to Sharesight. And then it just walks you through step by step. I think about a two-step process, one-step process. If you've got a Sharesight account, and if you don't, you just need to sign up. And you can sign up to a free account to connect as well. So you can just sign up and check them both out. And just like Jess said, make sure if you have, a few Hatch investors have already been sort of downloading their transactions and sending them through to Sharesight. So just make sure if you've been doing that, you only send your future transactions to just avoid a bit of admin mess. Yeah, when it comes to your tax requirements through Hatch, we absolutely give you your tax information at the end of each year. So if you invest under 50, if the cost amount of your investments through Hatch is under 50,000, we show the two big numbers of the income you've received and the withholding tax you've already paid in the US, so you can just plug those into your return. Everyone also receives all the spreadsheets that you need to send through to your accountant, so you do have that option available. And I suppose for us, the biggest advantage through Sharesight is, rather than downloading all those spreadsheets, which I mean, like, it's not killer, but you can just click a button instead. So
Thanks, Nat. Just quickly, just to close off, don't mute yet. Can you chat about, hang on. Okay, just chat quickly about.
I saw, let me see.
No, it's, well, firstly, chat about the filters that we have. Just, do we have a screener type tool to select the stocks that we deal with? So maybe something about filters, but then also,
okay, I'm just going to do that.
Oh, I know, I got it.
Okay.
Talk to us through, we know that when you hold US dollars in Hatch, it's moved to a money market fund. So just talk briefly about our filters and then about the money market fund dividends.
Awesome. So firstly on the filters, basically Hatch, and I think I kind of keep drumming this home, but we're about Kiwis growing their money and getting rich slow over the long run. We're not really designed for kind of that day trading, thousands of trades a day sort of thing. So one of the things that Drive Wealth, who's our US brokerage partner, and us have in place is we list 3,500 investment options on the US market so far. But what we do not list generally is what they call penny stocks and OTC stocks, the over-the-counter listings that aren't on those main NYSE and NASDAQ exchanges. And the reason for that is actually, unlike in New Zealand that we have quite low share prices. The average share price of a company or ETF on the US share markets is about $60 or something. So when a company or ETF, the value of each share drops below $1, actually the underlying exchange places them on a watch list and they are at risk of being delisted. So as a precaution, Drive Wealth also places on a watch list and tries to avoid an investor getting into a situation where they buy shares that then become very, very hard to sell. If the share price bounces back, it comes back off it. There's a few other little rules around that too, around the value of the company. It sounds crazy when you talk in New Zealand language, but there are 3,500 investment options roughly that have a market cap of $1 billion in the US, and that's another requirement. So those I don't want to say protections, but those filters are in place to just make sure it's easy and convenient to trade, and that people aren't left in a position where they're stuck with shares that they can't sell. And that's not necessarily our rule. Like I say, it's the underlying exchange that they're not interested in keeping those investments on. The second question that you asked, Kristen, I've forgotten now. I had it at the top of my tongue. What was the second one?
Was it did we talk about the money market fund?
Money market fund.
Yeah.
So, and is that taxable? Is that what you were asking?
Yeah, just does that
fall under the
included in your, yeah.
So the money market fund is an investment. So when your money is swept into that, just for people who don't know, when you deposit money into Hatch, at the end of each US market day, any money sitting in your Hatch account is, they call it swept, put into a money market fund. And the purpose of that fund is a low risk storage facility. Basically, your money actually has to sit somewhere in the real world, and that's the option Drive Wealth has chosen, and like I say, it's chosen to just be a low risk way to store your money. The benefit of that is when there are interest rates, and I know interest rates are at an all-time low for that actually you're earning dividends on that money while it's sitting in your Hatch account. So from the first day you put your money into Hatch, you are putting that money to work, which is cool. Obviously interest rates change over time, and at the moment they're pretty low, but it's nice to earn something when you can. But yeah, it is an investment, so it does count towards that fifth rule. What we are looking into with Drive Wealth going forward is whether or not we can also add an option to have your money stored in a US bank account, in which case that wouldn't count under the fifth rule. So we are aware that can be for some people in some situations. There's a very, very niche situation where that could end up having a tax implication that's not ideal, but yeah, so we're looking into that. Kristen, I think I had one for you, just quickly about
I'm gonna do it
in China.
Yeah.
I figure you'll be
got it. Yep, perfect. I saw that one. Good. So the United States is putting forth legislation. It's already passed one round. It has to pass through the House of Representatives and then be signed off by Trump. And it's a law basically that says that if foreign companies listed in the US, which are again considered American depository receipts or ADRs, do not comply with US kind of oversight, So they have to comply with a number of rules. The regulators should be able to go in and audit these companies and have oversight over their effectively financials of these companies. They will be potentially delisted from the US share markets. And so that's something that's going through and is big news now because, of course, a number of US, in fact, global investors that are investing in the US share markets do own these ADRs. So the risk is that if they do not comply with these US regulations, and China has been targeted particularly because of a company called Luckin Coffee, who IPO'd and listed on the US share markets, it's come to light that there's been significant fraud there. And the SEC has claimed that, look, these companies that aren't willing to open their books to the US regulators are in fact placing these investors at risk. As such, if you're not willing to do that, you're out. And so this law, if passed, will have an impact if you are an investor in certain funds. If they choose not to comply, they will be delisted. And so that does mean that they may move to the OTC market. So some shares that are delisted from the New York Stock Exchange or the NASDAQ get flipped to the OTC markets, of which Hatch doesn't. You can't buy or sell on OTC markets via Hatch, but you can certainly sell. So that might move to a sell-only position, but it's not guaranteed. It's an unknown. It could be that they're completely removed from all share markets in the United States. So it is a risk that you need to think through when you're investing in ADRs. Please keep updated with this news. Do a quick Google search on foreign listings and the US share markets, and we'll just have to watch and see if this law is passed. But please do go in with eyes open in that space. I hope that answered that question. Just want to chat back to Dean. We've got some questions. I'm not going to mute myself here. Got some questions about the 50,000. Again, sorry, just to be super clear, is that per individual? What if it's a joint? What if it's household? Can we talk about at what point is that triggered with investing?
Yeah, absolutely. So it's the $50,000 New Zealand dollar threshold applies on an individual by individual basis. That's the first point. So if you've got say a couple or a couple of partners investing together, in theory the threshold should be $100,000 for them. That's pretty much how it works. It doesn't apply, say, if you're investing through a company or a trust. It applies to natural people only.
Thank you. That's great. A question for Sharesight. Does Sharesight capture this money market fund dividends for the fifth rule? And then also, can I use the Sharesight expert plan fifth report figures to file my own personal tax tax return instead of using an accountant? And that is someone who's over 50K.
I'm going to take the first one because I think that's probably more of a Hatch question. Sharesight, we don't send through the money market fund transactions, but what we do is at the end of each tax year, we just give you a spreadsheet to download and upload into Sharesight. There's a long story behind why we don't do that, but basically it's to do with the complexities of the transactions. So we may add it in the future, but it's really as simple as that in your tax reports at the end of every year. And actually, I think in Hatch most of the time, I can get clarification on that. You can just download a spreadsheet and upload it. So very, very simple.
Yep, and you can definitely use Sharesight to file your own tax returns if you're comfortable doing that. I guess we can't offer you tax advice, and especially personalised tax advice at Sharesight. So we're always going to say to you, if you've got questions or if you're unsure about anything, go and talk to your accountant. But if you're comfortable to do your own tax, absolutely, you can do that with Sharesight.
Thank you. Just a quick question actually we've had two come in. Sorry, Dean, on this one. Can I be a trader and an investor at the same time? And I've seen this happen. I know that people use Hatch for their long-term investments and they might use another account to be a trader. So can you walk us through implications there?
Yeah, gee, great question. And I think the short answer is yes, you can, but be careful. So I think if a person has a share trading or share dealing business underway, and then revenue starting point will be anything that person does is related to that business. So yeah, technically possible, but I'd strongly recommend professional advice to make sure that the person sets up their affairs properly to distinguish between the two.
Good. And last one, Dean. I'm curious if you've got over 50K, does it matter if you're a trader?
Great question. Super question. Short answer, no, it doesn't. If you're over 50K, you're then into these fifth rules that we've been talking about. So under the fifth rules, your income's calculated totally differently. If you're under 50K, that's when it matters whether you're a trader or not, or whether you bought the shares with the intention of selling them. So different tests apply depending on whether the cost of your investments are 50K or more.
Thank you. This question is for Natalie. Nat, wondering about joint accounts, and because that matters, also with any death taxes in the US.
Yeah, joint accounts are definitely on our roadmap. We're aware, for a couple of reasons. One, a lot of couples like to invest together and have their money in their joint names. And then secondly, just for anyone who's unaware, US estate tax, it's not something we really think about much in New Zealand. But if you pass away in New Zealand and you have money invested in the US, they do make you pay tax on that. And one of the ways to avoid that being the case is you can have a joint account. One of the ways, there are other ways. We'll not avoid it, but not fall under those rules. Never avoid paying tax if you're meant to. So it's definitely on our product roadmap, and we are currently, just so everyone is aware, we are the top features coming through at the moment. We have stop losses and good till cancelled orders, which is basically you can set the expiry date of your order. They've been in development for a while. We've gone through thorough testing, and we've had our first tranche of Hatch users use them, so they'll be launched in the next few days. We're also about to launch a referral program for anyone who loves Hatch, and we know people have been our unofficial salespeople for years now, who've been getting their friends signed up for free. Now we'll reward you both for it. And then next up after that is actually kids accounts, because we've got so many people who are already investing on behalf of their children through Hatch, and we just think it's awesome that you can give kids this amazing financial education and help them start to build their portfolio and normalize growing their money as part of their life. So it's not that shock that we've all had when you turn kind of 25, 30 and realize it's probably not a good idea to leave your money sitting in a bank account or spending it. But joint accounts is definitely kind of lurking kind of somewhere in the list behind that, but it's on our radar. Sorry, that
Thanks.
was all.
And before you go, what about short? Do we allow shorting on Hatch?
No, short answer, no. Long answer, kind of. Shorting, like I say, we're about Kiwis getting rich slow, growing their money over the long run. We're not really about that kind of intensive trading, complicated tools that awesome. But for the majority of Kiwis who just really want a really solid place to put their money to work, that stuff can be kind of confusing and intimidating, and it's not really philosophically where we're at. However, because we have these 500 ETFs through Hatch, a lot of them are leveraged ETFs and inverse ETFs. So you actually can somewhat short stocks through the US share markets by investing in these. One of the advantages of them is you limit your losses, unlike when you short shares and you your losses are limitless. When you invest in one of these inverse ETFs, the maximum you can lose is the money you're invested. So, I mean, I like them a little bit more. And we've got a stock pick challenge happening this year, which is just the brilliant year to do a stock pick challenge, because you just see all these different couple of hundred people and how their portfolios fare, and why long-term investing, we keep harping on about it, because you just see from month to month the differences. But I've got to say, in about February, March, some of the top performers in that stock pick challenge were all invested in these inverse ETFs. So for
a couple of months.
Yeah.
Which brings me to this next question. Does anyone want to chat about your current approach to investing in the current market? This is just a personal thing. If anyone wants, no pressure, but if anyone wants to chat about it, just quickly, I actually upped my contributions to my Kiwi saver in the dip. I viewed it as an opportunity to maximize my Kiwi saver and know that the markets will recover. And when they do, I'm simply buying more shares at a cheaper price. I can't probably say that today, recognizing that the share markets are almost back to highs, I think within 15% of those highs. But my current approach is I've upped my Kiwi saver contributions, and on my Hatch account, I've probably invested in a few different things that I might not normally. So like things related to kind of consumer spending. So you know, anything to do with kind of consumer spending, I've thought, oh, I might just put a little bit of money in there, not necessarily long term. But that's kind of me. Nat, do you want to talk about anything?
Of course, I love talking about my investments. I very similar in a way. I mean, I saw it as a mad opportunity, especially because I'm a huge believer in investing businesses that I know and believe in. So for me, it was just a no-brainer when those same businesses that I think in 20 years' time will be in a brilliant position were on sale, basically. So it was just a really good opportunity to get more for my money. Like Kristen says, the dip has bounced back. Who knows? I feel like there's a lot of uncertainty as to what's propping up the share prices at the moment. I'm keeping an eye out to a degree, but I mean, at the end of the day, for me, investing is very much around the long term, and I just kind of chip away at it and keep putting money in. And sometimes, yeah, I'll take advantage of the opportunities in the dip, but I'm not gonna. I'm still dollar cost averaging my way through month to month. So yeah, kind of. Very little change other than, yeah, taking advantage of some really good companies at a discounted price.
Thank you, Nat. If anyone else wants to jump in, feel free. Usually Nat and I are a little less shy about these things, and that's fine. We can leave that there. Look, we've got 4 minutes left, and we are going to end on a high note talking to either Isla or Dean, and we are going to talk about actually quickly DRIP. I see that people are asking about Hatch and dividend reinvestment. So it's something that we think would be so cool to be able to offer with the US side of Hatch. And we're chatting with our US broker about that. So we're kind of dependent on them to do that. So we hope that dividend reinvestment is coming there. However, as we add new investments going forward, being New Zealand funds, we'll certainly look to having those. It's a little bit trickier on the US side. With respect to, sorry, we're going to end on a high note about tax. So how do you determine which tax calculation income to use between the dividend rate method and comparative value method? Start with that one. And does it make, can we load historical positions and back calculate FIF? So there's a question about kind of back calculating FIF and then the two methods of FIF. So talk about who, Dean or Isla, you have 2 minutes.
Okay, thank you. So choosing between the FIF methods, I assume it's FDR versus CV. I guess just a quick one. FDR stands for fair dividend rate. For whatever reason, it's been set at 5%. You can debate that. There's a lot of people that have debated it. That's what it's set at. Comparative value is basically doing your actual returns, and that includes realized gains and losses. That's where we talked about the distinction between traders and non-traders falling away when you get into the FIF rules. So broadly, as I think Scott mentioned, if you're a natural person, so an individual or certain trusts, you can look at each year at your CV outcome and your FDR outcome, look at the numbers and pick the lower one. You can't go into negative. So if you make a loss on your CV, you think, well, brilliant, I can claim a loss. You can't, but you cap it down to nil. So you can decide each year which you go with. You just need to be consistent across all your investments.
Thank you.
You need to look at the two outcomes and decide what's the best result for you, and often the numbers to go with it. And
in terms of back calculating?
Yes, I think, assumed, does someone mean partway through the year you thought you were going to be under the 50K and then you're over it during the year? Well, I guess your deadline for filing your tax return is 7th of July generally, unless you've got a tax agent and then you get an extension. So that's after the end of the year. So you can look at the end of the year, look at all your cost balances throughout the year, decide, work out if you need to apply the FIF rules or not. Is that
Thank you.
a question?
Yeah, that's great. That's great. So look, thank you so much, everyone, for attending. There are a few questions we didn't get to, so I'd like you to invite, I'd like you to please email Hatch, because we can obviously direct anything to Sharesight, but also Sharesight, I'll let Jess end off as well. But with respect to Hatch, please do reach out to hello@hatchinvest.nz with any of these questions that didn't get answered. Happy to answer them or hand them off to like the great partners that we've got. So again, that's hatchinvest.nz is our website, and we're always available to chat if you just want to reach out to support. And Jess, how can we reach Sharesight?
Yeah, thank you very much. Thank you very much for everyone for joining and for everyone presenting. So you can reach Sharesight at support@sharesight.com. If you haven't signed up for Sharesight, go to sharesight.com and you can sign up for free and get started. We have a help page on how to connect as well, and we will, is when we email everyone the recording of this webinar, we will kind of send some help pages for how to kind of get connected to Hatch and Sharesight and then link them together. But thank you very much for this evening.
Thanks. Yeah, thanks, Jess. Thanks, everyone. Thanks, all the attendees.
Just one last
thing
thing
to reach
before
out.
we go. The only last thing is we're pretty serious about this partnership, so we will be doing a lot more webinars and events with these guys. We're all in Wellington. We're cool New Zealand companies, so if you do have any things that you'd like us to be talking about in the future, just get in touch as well, because we are here for you. So yeah, hit us with what you want to hear about, obviously tax and anything else, and we'll keep these things rolling.
Yeah,
Thanks,
absolutely.
Nat. Thanks, everyone. Have a good night.
Cheers, guys.
Thank you.